But to paraphrase Chairman Powell from 2 weeks ago, they don't want the Fed to add uncertainty to what is already an extraordinarily challenging and uncertain moment. And I think the Fed is going to be guided towards moderation because they just don't want to add to uncertainty here.
So, Mona, let me jump in and ask you a question. We were talking just a few moments ago about how many rate hikes to anticipate for this year and how the changing nature of the climate geopolitically and around the globe may affect the number of interest rate hikes we get this year. Your thoughts?
Yeah, absolutely. Look, I think all eyes will also be on the new set of economic projections, the new dot plot, quote unquote. Keep in mind that at the December meeting, they had a 0.9 projected for 2022, so about 3 rate hikes. We do think that'll move up, probably 5 rate hikes at least this year. I think at that point, the Fed has some room to take a pause, look around, see what the impacts to inflation and growth are before deciding the pace going forward. We think all in, we're still looking at 2.25% to 2.5% terminal rate. It'll be interesting to see if their projections reflect that as well. And we're also going to see what they do with their inflation outlook and growth outlook for the year. We suspect growth moves downward and inflation moves higher as well.
2-minute warning, John Bellows. Where's your mind focused?
So I think today's pretty straightforward. I think the risks are they're hawkish today. You know, inflation's high and job growth has been good. But I want to pick up on something Mona said. I think it gets much harder from here. I think the downward revision to growth is a sign of things to come. The growth risks are to the downside. I think the uncertainty in Ukraine probably adds to those. And so while it's pretty straightforward to hike rates today when job growth is okay and inflation's high, it's going to get a lot trickier when growth risks start to emerge on the downside. And so I think straightforward today, but harder in coming meetings, and harder in particular because the growth is likely to decelerate. And risks are that it decelerates more as we move into the end of the year.
But curiously enough, David Kelly, the argument Larry Summers was making in the Washington Post last night is that he's sort of blaming the Fed for that slowdown. We all say, oh, the macro slowdown happened to the Fed. And he's saying, no, it's because they're letting policy run too hot that we're going to risk recession and stagflation.
No, I don't really agree with that. I think that the other side of Washington has kind of set this up by putting massive stimulus into the economy during the pandemic, both to protect people who are affected by the pandemic, but also to protect people who weren't being affected by the pandemic. That gave you excess demand meeting insufficient supply. That's why we got all this inflation here, and that's why we're coming in too hot towards full employment. But the Federal Reserve can't fix all of this. I think the Federal Reserve needs to be steady here. I agree with John that there is a danger that the economy is going to slow in 2023, and what the Fed doesn't want to do is overdo it and have to change course. I'd rather the Fed take it slowly here and have multiple years in which they try to get rates and their balance sheet back to normal, rather than precipitating a crisis.
Dow's up 242. Let's get to Steve Leisman with the Fed decision. Steve?
Federal Reserve raising interest rates to a new range of 0.25 to 0.5%, up a quarter on the range. The Federal Reserve saying it anticipates ongoing increases to the Federal Reserve funds rate. It expects to do balance sheet reduction, quote, at a coming meeting, not specified what meeting, but specified that it is at a, quote, coming meeting. The Fed saying is prepared to adjust rates as needed relative to risks in the economy. St. Louis Fed President Jim Bullard dissented, preferring a 0.5% increase. Now, onto the Fed forecast. If I've done the math right, which I think I did, the average Fed official, the median Fed official showing 7 hikes for 2022, up to 1.88%. Further hikes forecast for 2023 and 24 for both years. That would bring the funds rate up to 2.8% both years. So the key right there is that the median Fed official right now is expecting to raise the funds rate above the neutral rate, which is 2.4% in the summary of economic projections. The Fed also, of course, hiking the 2022 inflation outlook. The median forecast now at 4.3%. That is plus 1.7 percentage points. Further, it says inflation remains elevated and says supply and demand imbalances, along with a variety of other factors, are causing it. Ukraine invasion, they say, is causing human and economic hardship. Implications of the invasion for the U.S. economy are, quote, highly uncertain. However, it is likely to create upward pressure on inflation. One more note here on the economy. They say indicators of the economy have begun to strengthen and job gains have been strong. So good on those two scores. But I think you have to underscore that now the median Fed official does see the funds rate above the neutral rate for 2 years. Kelly?
A lot of huge developments here, and we're seeing some big moves already across the market. Steve, stay right there as we bring our panel back along with Bob Pisani and Rick Santelli. Rick, can I start with you? Some immediate moves in the bond market here.
Well, I like to watch the yield curve. That gives you all the immediacy. The yield curve tends to twos. Right before the announcement, it was trading 31. Now it's trading 27. So what happened is we are seeing short maturities like 2-year and 3-year notes, even out to 5-year notes, much more responsive with the selling pushing rates higher than the long end. You know, we're coming close to 220 in a 10-year, which was at 218 prior. So that is the move there. And if you look at the dollar index, it's rallied just a bit. And, you know, it's in a zone of roughly a 2-year high. But to me, watching the markets, listening to Steve, it seems to me that we are all putting an awful lot of faith in the market's assessment on the fly of what 2022 is going to look like by year end with respect to the Fed. And I will continue to throw it out there that whether it was 2018 or other cycles, that these things can change very quickly. Just look at December of 2019 Fed funds as the market at the end of 2018 had tightenings, then didn't want them anymore and just kicked them right back out.
Rick, thank you. Bob Pisani, your thoughts here on the markets, which we immediately saw the Dow come off its levels prior to the decision, but it's still hanging on to about a 150-point gain.
Yeah, it's pretty modest. We're down 7 or 8 points in the S&P 500. This is buy the rumor, sell the news. Powell is essentially not saying anything that people were not anticipating, playing up high degree of uncertainty, it looks like, in this statement. They're trying to maintain maximum flexibility. I think he'll leave open in the presser the possibility of more than 25 basis points. Some people might be a little bit disappointed that we're looking at 7 rate hikes. That's essentially one for every meeting in 2022. But I'll tell you how confusing this is, Kelly. Half the traders down here believe the Fed is going to make a policy mistake by not raising rates fast enough to combat inflation, and the other half believe the Fed are going to make a policy mistake by raising rates too fast, too aggressively, and will induce a recession. That's how confusing things are. And remember, when you're that confusing, you stay right in the middle. It's like chess. When you don't know what to do, just push the pawn. I think he's essentially just pushing the pawn right here, and this is pretty much in line with the expectations.
Let me turn back to our panel. John, if I may, I'll call you the most bearish, although I heard David Kelly not wanting to see a lot of these hikes either. So, John, what's your reaction as someone who's worried the economy is slowing to the fact that the Fed itself now expects to raise rates a quarter point every meeting 7 times for the rest of the year?
Yeah, I think that price in particular was already in the market, but I do think that the risks are there. You know, I think one thing that you just heard is the yield curve's flattening. You know, as bond investors, we take that seriously. And I think that's kind of the message there is clear, which is as the Fed's hiking interest rates, you know, the growth risks are there. And that's why people are buying, you know, preferring back-end bonds to front-end bonds. So, you know, I'm not sure that the 7 rate hikes is all that different than what the market's priced, but I do take the yield curve flattening seriously, and you know, the risks are there. I think at some point, by the way, I think the Fed's going to take that seriously as well. The Fed is not unaware of what the yield curve's doing. And so at some point, you know, if those growth risks materialize, that could change their tone. It could inject a note of caution. It could ultimately get them to slow down a little bit. We're not there today. That's not what's happening today. But that's certainly a possibility in the future.
That said, David Kelly, the Fed itself has acknowledged that the long end may be 1.5 points below normal because of quantitative easing and other factors. So they may or may not take the 2s, 10s as gospel here, even if it's down a couple of basis points, about 5 basis points at last check on this decision.
Well, that's right. And they can always affect that. I mean, I think this was a hawkish statement. I think that, you know, having a descent from Bullard is hawkish. And I think, you know, putting 7 hikes into the dot plots, I mean, even if it were 6, it would be less hawkish. But 7 basically means that at every meeting now, the expectation built into markets is the Fed goes. And it's a very aggressive. I mean, I spent years saying the Federal Reserve shouldn't have had rates this low because they're destabilizing financial markets in the long run. But it looks like they're in danger of making the classic Fed mistake of waiting too long and then doing too much. And I'm just worried that this is pretty aggressive here for a rather uncertain economy that's going to slow down as we hit full employment.
Mona, as I listen to this, with great respect to our panelists here, it feels like a very different discussion from what people on Main Street might be feeling right now about inflation, where they're looking at this and going, we have an 8% CPI, and the Fed's talking about raising rates from basically 0 to, you know, what would that be, about 1.5% by the end of the year. And What do you think? I mean, is that too much? I mean, markets may not be that happy about it, but is that exactly what we need to kind of bring things back into check here?
Yeah, look, I mean, consumers are certainly feeling things not only at the gas pump, but at the grocery store as well. So especially that low wage earner is feeling it more than the average American consumer. But what I will say is if you take a step back, the U.S. economy came into this crisis and this Fed rate hiking cycle with relative position of strength. So we had a healthy consumer, but we also had nearly $2.5 trillion in excess savings versus pre-pandemic levels. We were looking at economic growth in the 3 to 4% range. It looks like the Fed's downgraded that to 2.8% for this year. That's still above pre-pandemic trends, above potential growth of 1.5% to 2%. So this is by no means an economy that is slowing to any sort of recessionary conditions. As the Fed tightens, if you look historically, it does take on average about 24 months to get to a recession, if you get to recession. Not every Fed cycle ends in recession. So we do have a little bit of leeway here. And in the meanwhile, we've seen markets sell off, and we're down 10% in the S&P, 15% plus in the NASDAQ year to date. So not a bad position in terms of oversold contrarian indicators heading into a Fed cycle as well.
No, I appreciate the points. We're showing some of the yield curves there. It looks like 5s, 10s was flirting with inversion. 2s, 10s, a little bit more of the favorite one, down to about 23 basis points. But again, whether or not that's actually predictive of recession right now is a huge topic of debate. Let's turn back to Steve Leisman, who's got some more detail coming through this. Steve, we should show, these couple, look at the levels. And I think I just saw the 5 years around 220, the 10 years over 220 on a 2-year chart. These are some incredible moves, just incredible.
The market's adjusting to two realities here. The first is the reality in the Fed statement. I want to get to that in just a second. The other is the reality that, not the reality, but the possibilities that David Kelly's talking about, the idea that it will be too much. I think that's what drags down the long end. But I want to make 2 points here. First of all, the market has very quickly priced in, the futures market priced in that 7th hike with a 63% possibility, beginning to price in that 8th hike. I can't get a great read on it, but it looks like it's pretty close to pricing in that 8th hike for February. But to me, the profound difference here is the belief by the median Fed official here that for the years 2023 and 2024, the funds rate needs to be above neutral. I don't know, maybe Larry Summers is doing a jig someplace because he just won at least part of the way. The notion that Larry laid out in his piece at the Washington Post that the Fed, and this is something we've been asking our panels about, we've been talking about for a very long time, would the Fed have to raise above neutral? At this point now, your median Fed official believes that to be the case, and I believe that to be a pretty profound shift on the part of the committee here.
Well, Steve, let's pick it up and come back to Washington now, joined again by Ivory Johnson and Jamie Cox. I saw the two of you when we talked about 7 interest rate hikes this year, both of you shaking your head when I believe it was Rick first mentioned about the yield curve coming tighter on 2 years, 2 to 10s, 5 to 10s. You were nodding. That's an important point. You don't believe that the Fed is going to go 7. They're not going to be able to hold to what they said?
No, I think the word of the phrase of the day is going to be policy error. I mean, that's the problem. They were late in 2021, and now they're going to go too fast in 2022 and perhaps even throw the economy in recession. I don't think they need to wax Paul Volcker here. I think they need to be patient. There's a lot more going on. The economy is much different, and there's no reason for the Fed to go this quickly. They have other tools, other levers they can pull. They can bring rates where they need to be and can control inflation in different ways with the balance sheet.
This is a year to keep your knees flexed across all areas. I mean, you got to be in ready position, Ivory. Let's talk about, I mean, it's clear that Fed Chair Powell has targeted inflation as objective #1 here. But he risks, in an election year, the worst of all possible fates, and that is stagflation, or a recession, or close to a recession, and really punishing inflation.
Yeah, I think it's going to be difficult to raise it 7 times. And the big takeaway for me was a yield curve reaction.
Yeah.
Understand that the market is already saying we don't have growth because they're discounting the time value effect. But let's go one step further. The 10 and 2-year spread on the OIS 1-year forwards was at negative 0.14%. That suggests that the yield curve might invert. And so that just gives you a sense of how little growth we have.
And we're looking at the highest yields on 2s, 5s, and 10s since 2019. Let's bring it across around third base and bring it home. What should I do with my money right now?
Well, I think if you have been involved in financials, you're going to be very happy. And, in fact, in the last 30 years, there's been a change. Actually, the last 30 years, when interest rates would rise, there would be a negative correlation to high dividend-paying stocks like utilities and things like that. Well, in 2021, that reversed to a positive correlation. So there has to be some explanation for it. So partly it's because we're coming off a low base, but the other is because energy and material companies are now some of the highest yielders. So if you like the inflation play, that's actually going to be a place to be.
Quick thought from you, Ivory, before we toss back to Kelly for a market check.
I think when the economic growth slows, you want to own gold, and I'd be counterintuitive.
Gold?
I'd own gold, and I'd own long bonds, because when you have disinflation and expectation of lower growth, that's good for bonds.
All right, Ivory, Jamie, thank you very much. Kelly.
We want to just check on the markets, guys. The Dow has gone negative. So remember, we were up more than 200. We were up more than 500 points before the Fed earlier today. Going into the decision, we were up more than 200. The Fed is now down 45 points. The Dow is now down 45 points. The S&P is up 8. The NASDAQ is up 110. David, Kelly, quick reaction?
Well, I'm not surprised that the Dow is down. I mean, I think this is a very aggressive move. I just want the Fed to maintain some flexibility. In the long run, we've got to get rates back to positive real levels. But there's a lot of uncertainty out here. And remember, we've got a lot of financial assets which are built on the edifice of super low rates. And you can't just raise those rates up to normal levels overnight and expect nothing bad to happen. So I think it's a little dangerous. I'd rather the Federal Reserve just take it easy, do more work on the balance sheet than on these rate hikes, and just try to stretch this out. But that's not what they did today, and clearly they're being pretty aggressive here.
John, how do you think the bond market is going to further react to this? As you've kind of given us your warning about, you are concerned about the yield curves, although others may not be quite as much. You are concerned about economic growth. How should we expect everything from the long end, which we said earlier, that's where we're pricing auto and home loans? How should we expect that to behave? How should we expect credit markets? The high yield was looking pretty good today prior to this meeting. Give us your sense of how markets are all going to shake out here.
So I think there's some value there. I think there's some value because, you know, even the Fed's saying 7 hikes and now the market's pricing 8, if I heard correctly. You know, I do think long bonds do provide some diversification. And then finally on credit, you know, credit spreads have widened. Their prices are a little bit cheaper than they were at the beginning of the year. And if we can avoid the Fed policy mistake, and I think that's the big question, there's a lot of time between now and the end of the year for the Fed to get this right. If we can avoid that Fed policy mistake, you know, I think you will realize some value in credit. So yields are higher, spreads are wider. You know, I think you need to be looking at this as an opportunity.
All right, Mona, what would you add to that and to investors looking at stocks here and wondering, okay, you know, we see often kind of a three-act play in response to the Fed. We get what happens in the first couple minutes, sometimes predictive, sometimes not. We get what happens between the decision and Powell, sometimes predictive, sometimes not. Then we get the act that begins after we hear from Powell and often lasts into the coming weeks. So how much should we make of what we're seeing thus far?
Yeah, you know, the immediate reaction isn't usually what happens over the long term. What we will say is in some ways the Fed is being smart here, putting out 7 rate hikes at a time when the economy is still, you know, somewhat more resilient, and then being able to pull that back if needed. I think that would actually be supportive of markets over the long term. But in the near term here, we do think that some of the overhangs that the market has been worried about, they wanted clarity from the Fed. They're starting to get that, and we'll see how Jerome Powell talks through the conference today as well. We are also seeing a little bit more hope around a diplomatic solution to the geopolitical crisis. So if both of these overhangs are lifted, or at least we get a little more clarity in the weeks ahead, we do think that some of the, the correction that we've seen in the market, we could get a rebound with, you know, some of the safe havens reversing, some of the commodity prices rolling over, and perhaps, you know, finally some of that reopening 2.0 as the pandemic trends here in the U.S. at least improve. The value cyclical parts of the market start to improve as well. And financials is certainly part of that as the Fed is moving.
All right, as we watch this all play out, let's turn back to Rick Santelli. Rick, as the bond markets digest these moves.
Yeah, I think it's very fascinating to see 3s, 5s, 7s, and 10s all are having a traffic jam as they get their yields closer and closer. Of course, 7s to 10s have a minor inversion. They had a minor inversion back in February, a minor inversion in 2008. But then again, it's a liquidity issue. 7s just aren't as liquid, just like 20s. 20s have had the highest yield on the curve for a while. It's a liquidity issue. But I think we're all losing sight of one big thought. And that thought is the curve's going to get flat as a pancake, and it's going to see all short rates gravitate to the 10-year rate, which my guess is going to be around 2.5%. More importantly, we are witnessing something historic. the end of globalization, the end of just-in-time inventory, and all of that is crashing in a post-COVID Russian invasion type world. And what it means to me is you could talk about stagflation, name it anything you want, but labor costs, energy costs, and housing costs aren't going to be moderating anytime soon, and ex-food and energy will take on a monumental meeting in the quarters ahead.
All right, and finally to Bob Pisani with a last thought on stocks here, Bob.
Well, we were up 40 on the S&P, now only up 10. The Dow's dropped essentially almost 300 points. I said earlier, the problem is half the traders think the Fed's not going to move quickly enough to deal with inflation. The other half are concerned they're going to be so aggressive they might induce a recession. They're acting like this is a little bit on the aggressive side. The 7 rate hikes this year, the 2.8% for 2023. So we'll see. But as Rick said, this is a very difficult situation. It's not clear how well and effective they're going to be combating inflation, and at the same time, they may eventually stall out the economy. I think you're going to see a lot of demand destruction this summer around things like gasoline. We're already seeing about around used cars right now. That may help slow inflation down and slow the Fed down itself. A little demand destruction.
All right, Bob Pisani, thank you. We'll check back in soon. And a real big thanks to our panel guys today. John Bellows, David Kelly, Mona Mahajan, standing by to walk us through this big Fed decision, a historic one with the first rate hike since the end of 2018. Coming up, former Fed Governor Randy Korszner joins us with his analysis of the Fed's decision, his outlook for the pace of tightening and the risk of recession. Fed Chair Jerome Powell's news conference just minutes away begins half past the hour. We will have live coverage here with the Dow up 44. We're back in a moment.
This CNBC program.
Really important that in anchored. And of course, these disruptions associated with the war in the Ukraine, with the lockdowns in China that are going to disrupt supply, other supply disruptions, that's outside of the Fed's direct control. But that doesn't mean that the Fed shouldn't respond to it. People don't care what the source of the inflation is. When they see prices going up, they're going to demand higher wages. And if the Fed's not doing anything about it, they're going to say, the Fed doesn't care. And so I want even higher wages because inflation went from under 2 to 8, and it could go to 10.
Randy, how does the Fed thread the needle and go from maybe behind the curve, to use the cliche, to at least equal to where the curve should be? How do they do that without, as the yield curve is telling us, tipping the economy into a recession?
That's always the challenge, because of course they've got to rebuild credibility and make sure that it's not clear that they've lost credibility, maybe a little bit, but make sure not to lose it and build credibility. And so in the late 70s, Paul Volcker had to raise rates very significantly, unfortunately, tipping the economy into recession. I think with the combination of higher rates and with all the uncertainties of war and sanctions and weighing on investment, weighing on people's consumption, it's tough. And so I think the chance of us tipping into a recession is now reasonably high by the end of the year, beginning of next year.
Let's talk a little bit about the decision not to begin to reduce the Fed's balance sheet at this meeting. That sounds like it is over the next hill. How important is that in, number one, fighting inflation, reducing the amount of money that's in the system? And two, is that, I hesitate to use the word, a more humane way to practice monetary restraint than the more blunt instrument of raising interest rates?
Well, I think they both have to do with the amount of resources and reserves that are in the system, the amount of liquidity that's being put into the system. So they will work through similar means, and both will tighten credit conditions. So I think a reduction of the balance sheet would effectively be putting pressure on interest rates also. So I think the consequence is similar. I think what they wanted to do is start with something more traditional, 25 basis point increase, not a 50 basis point increase. They wanted to signal things are going to move in a direction towards trying to bring rates up. We still have to remember that inflation's at 8%. They expect to be at the end of this year at about 1.75%, 2%. That still means that the inflation-adjusted rate is negative 6%. That's still not very restrictive, but I think they need to do it, and I think they are on that path. And I think the balance sheet reduction will be a complement to that, but I think they're going to more have that in the background rather than use that as a primary tool.
A couple of our guests, Randy, were skeptical that the Fed would indeed raise interest rates 7 times and continue those hikes into 2023. Do you have any reason to be skeptical of that?
Well, certainly we don't know exactly where the economy is going to go. We don't fully understand the consequences of the war or what could happen. There could be very dire consequences for the global economy, or we could get a relatively quick resolution. Very hard to predict. And so if there were more dire consequences, it would have inflationary or deflationary effects. The Fed would take that into account. But I think, remember, as I said, inflation rate's 8%. They're only raising rates to 2%. Back in the 1970s, the inflation rate was in similar range, and Volcker was raising rates to double-digit levels.
Randy, what do you say to those who argue, and we heard this a little bit from Senator Warren last hour, that this is mostly just a pandemic phenomenon? I think she primarily attributed it to that, and then also said it was because corporations have too much market power and are raising prices beyond the level that the market is requiring them to.
It's really hard to see that there's been a dramatic change in market power over the last two to 3 years. So it's hard to say that suddenly corporations have become very powerful and they weren't that powerful before. Because remember, we had a decade of, well, in post-financial crisis, more than a decade of very low inflation rather than high inflation. So it stretches credulity to think that there's been this sudden change in market power. There are a lot of sources for the high inflation. Some of them have to do with the pandemic. Some of them have to do with the responses to the pandemic, like the large amounts of stimulus that were provided. I think that's one of the reasons why inflation is a bit higher in the U.S. than it is in other countries, because we provided more government spending and more stimulus. The initial response was very important globally, and so I don't want to suggest that was inappropriate. I have more questions about some of the subsequent sending out of checks to people, and that then leads to people having ability to spend and a lot of pent-up demand because they've been cooped up for a couple of years. So some supply things, some demand things. Not all the Fed's doing. Some perhaps the Fed's doing. But as I said, no matter whether it's the Fed's doing or not, it's the Fed's issue because it's about inflation and inflation expectations. And they have to worry about where inflation expectations are going to go, because otherwise it becomes much more painful. I know people want to wait, but it's very risky to wait because it could be much more painful if you wait and inflation gets out of control and inflation expectations get out of control.
It's a great point, Randy, and perhaps we can even show some of the inflation break-evens that we do track here. We really appreciate your time today, your thoroughness. Thanks for joining us.
It was great to be with you. Randy
Korszner with the Dow. Tyler, now down about 19 points.
Yeah, I'm thinking of the famous Howard Cosell called "Down Goes Frazier, Down Goes Frazier." And I know what lots of people are thinking, who was Howard Cosell? Because he was from way back when. But down goes the Dow, as we saw. Who was Frazier? Down goes the Dow, as we saw there, as the Fed came out with what I think is being interpreted as a much more aggressive targeting of high inflation. We are at a generational moment, I believe, Kelly. We haven't seen inflation this high, this persistent since the early 80s, when the Fed chair at that time, Paul Volcker, came out with a bazooka and went after it. Fed Chair Jay Powell is now in a position where he is having, and forgive me for using these wartime metaphors, but he is using sort of heavy artillery to target inflation.
Yes, and again, we're showing there the 5-year, 10-year spread, not of dramatic market significance, but it is negative for the first time in a couple of years. We also showed the 10-year break-evens a moment ago, and we are seeing that's inflation expectations in the market. They have come down. Of course, that is going to have to be a goal of the Fed's, given just how high they've gone. For example, on the 5-year break-evens, we were at 3.4% yesterday. That's the market's expected annual inflation rate, up from about 3% turn of the year.